Do you want to know how to analyze a rental property? Have you ever looked at a potential rental property deal but aren't sure if it's a good investment? In today's video, I'm going to show you how to quickly analyze a rental property without having to use a fancy calculator and without using a spreadsheet. If you stay till the end, I guarantee you'll know how to analyze a potential rental property, and I'll show you how to get your hands on the exact rental calculator that I've used to analyze thousands of deals and invest millions into income-producing real estate. Spoiler alert, just comment below and I'll send you the calculator. I'm Ryan Zomorodi and I'm the co-founder of realestateskills.com. Over the past decade, I've quietly amassed a rental property portfolio that's now worth over $10 million and allows me to collect over $400,000 in passive rental income every single year. From buying single-family rental homes to multifamily apartment buildings and even commercial office buildings, I've used these fundamentals that I'm about to teach you to analyze and profitably invest in real estate. So first off, why is it important to know how to analyze a rental property? If you're a beginning real estate investor or someone who's new to acquiring rentals, analyzing a rental property is the single most important skill that you need to master to ensure that you're getting into the right investment and that you're buying a great deal. Simply put, the better you are at analyzing rental properties, the better deals that you will buy. And the better deals that you buy, the faster you'll hit your goals as a real estate investor. Most of the investors that I work with and train are looking to grow their net worth with real estate investments, or they're looking to replace their income from their 9-to-5 job with cash flowing rental properties. A lot of them are looking to diversify their current investment portfolio away from the traditional mix of stocks and bonds and create real income that will outlive them. And my personal favorite, we use real estate to create a more reliable retirement plan than just stashing away money in a 401k and hoping it works out. So whatever your goals in real estate investing might be, learning how to analyze real estate deals like a pro is going to help you get there so much faster. Plus, most people rely on a real estate agent to help them with this aspect of investing. Take it from me. Most real estate agents do not know what makes a great real estate investment. The first realtor that I ever worked with tried to sell me a rental property that she said made an amazing investment. However, when I ran the numbers myself, I realized that I'd be losing almost $1,000 every single month at the price and terms that she suggested. See, the truth is almost any home can make a fantastic rental property. However, you as the investor must know with confidence what price and terms will make it a profitable investment. Otherwise, you'll never know what you're getting into. People will try to sell you what they call amazing rental properties. However, you and only you are responsible for running the numbers at the end of the day. Most people will try to sell you deals for way more than they're actually worth. Remember, as an investor, you need to be a shopper, not just a buyer. You need to know when to say no to a deal. It's all about the numbers. As real estate investors, we buy income streams that put money in our pocket every single month. We want to avoid buying liabilities that drain our bank account every month. Learning how to analyze a rental property the right way can make or break your investment. And if you get into a bad investment, that can potentially wipe you out for many years before you're able to get back into the game. And even worse, you might never get back into the game because it put a bad taste in your mouth. And that's the last thing that I'd want for you. So let's get right into it. How do you analyze a rental property? First, we need to understand how rental properties are valued. All commercial real estate, including residential real estate that produces income, such as rental properties, are valued based on the income they produce. This is what we call the income approach to valuation. This means understanding a property's income and expenses to determine what the net income can be. The more net income a property produces, the more it's worth, plain and simple. Wouldn't you pay more for a property that produces more income than one produces less income, all other things equal? I certainly would. Rental property investors buy income streams, so you need to learn how to analyze any property's income stream to determine what it's really worth. Now, while there's many ways to understand the income streams and analyze it based on a lot of different metrics, the two things that I optimize for when building my 8-figure rental portfolio are cash flow and cash on cash return. Let me take a second to explain what these are. So cash flow is simply what's left over after you collect all of a property's income and then pay all of the expenses. Think about it, what comes in and then what goes out. There's no need to make it more complicated than that. This is really the most important part of real estate investing. The simple formula is income minus expenses. This is how you get cash flow. So you want to buy properties that cash flow. This is one of the primary ways that you make money as a rental property investor. So not only can you make cash flow from the rental property, the cash flow actually helps you pay the bills and keep the property long enough to experience the potentially life-changing appreciation of value that a rental property can achieve. Honestly, most of the money that I've made in real estate has been from the appreciation of properties simply from holding these properties for the long term. Cash flow is the main thing that you want to optimize for as a real estate investor. Cash flow is truly the lifeblood of any rental property. Without positive cash flow, you'll be pouring money out of your pocket into the property every single month. So based on how much cash flow your property produces, you can start to determine if it's going to be a good investment. So you simply want to have more income than expenses, and that's ultimately what creates cash flow. But cash flow isn't the only thing that you want to look at. You need to understand how much you need to invest into the property to produce this type of cash flow. So this is where we get to our next metric. This is the cash on cash return. So think of this as your return on investment on a rental property, right? You have to pay some money to get into a deal, and then you're going to expect a return every single month and every single year. So the formula for cash on cash return is once you figure out your cash flow over here, you need to understand what's your annual cash flow, and then you're going to divide that by your total investment on the deal. So this is where we get to your return on investment, right? So this is the cash on cash ROI. So we like to say cash on cash ROI. So think about it. If you're investing $100,000 into a property and you're bringing out $10,000 at the end of that first year, then you can do the quick math. It's about a 10% ROI, 10% cash on cash return, right? But if you invested that $100,000 and you only made about $5,000 of net cash flow at the end of the year, then that's a 5% return. So think about it, you have money going into this investment and then you have the net income coming out. And this is represented as a percentage of your overall investment that you're getting back in that first year. So for example, let's just say that you have a property that is producing $10,000 of annual cash flow. And then your total investment was $100,000, right? So this means that maybe you bought a $400,000 property, you put about 25% down, and your total investment is $100,000. So you can do the quick math. You don't need a calculator for this one. That's about a 10% cash on cash return, okay? Now let's take the same cash flow and imagine if your total investment was less than that, right? So let's say that same $10,000, you only invested $50,000, right? So now your cash on cash return is double that. So now you're at 20%. So you can see how these numbers start to relate to each other. So the more cash flow you can produce on a smaller investment, the higher your ROI is going to be. This doesn't give you the entire picture of your investment, but let's take a look at another example so we can really break down this cash flow number in a lot more detail. So figuring out the income and the expenses gets a little bit tricky when you're looking at different properties. So let me break down exactly what the income and expenses can be with a real example. Let's take a look at this single family home that I recently purchased near Nashville, Tennessee. So I've never actually been to this property and I still haven't seen it in person, yet it's been making me passive income every single month when that rent check hits my account. So this property is a brand new construction, 4-bed, 2.5-bath home, right around 2,000 square feet that I was able to put under contract for $417,000 before it was even completed, okay? So this was a direct-to-builder deal that I found on the MLS. I purchased with the real estate agent. You know, this is something we teach in the Ultimate Investor Program. So I used our MLS offer system to find and acquire this deal, which was right on the market, and I paid full market value for this property. When I was looking for this property, I knew that there were private equity companies that were also buying in the area because I looked on title. Some of the neighbors were owned by large hedge funds that I could recognize. So I knew something was going on in this neighborhood, but I also saw that it was mostly owner occupants. So I knew that this area had potential for appreciation. First off, we want to analyze how much income can this property really produce. So this is where it all starts. You're trying to determine your gross revenue on any piece of real estate, right? This could be this single family home. It could be a duplex, triplex. It could be a large apartment building. What investors use are sites like Zillow, HotPads, Homes.com, Redfin, even Rentometer.com. These are all sites that can give you an idea of what your unit is going to rent for on the open market. So some of these sites like Redfin, Zillow, and Rentometer, you can simply type in your address to get an automated rent valuation estimate that you can quickly use within a matter of seconds and use it for your model. However, I caution you when using any automated valuation model because they can be inaccurate. So as you really dive into the data, you want to use these websites and look at what's actually on the market for rent right now. So look at rentals that have the same bed bath count, that are in similar condition and are in the same neighborhood, but also factor in the amenities that the property offers, such as a washer and dryer in the unit, or maybe a washer dryer on site. So maybe it's not in the unit, but it could still be on the property. And maybe some of the units don't have washer dryer on the property at all. What about the parking situation? Is there street parking? Is there a dedicated parking spot that's included with the rent? Or is that unbundled from the rent, meaning that they charge separately for the rent? Is it in a very dense area where parking is coveted and they just don't offer that? So in some areas, parking is a very big factor, right? Is there a garage? Is there a carport? So some of these things will be market dependent. And in some areas, there's a premium for parking. You also want to take a look at the pet policy. Does the unit not allow any pets, or do they allow only cats or only dogs, or maybe both? So that can tell you if they're attracting a larger pool of tenants, which is going to increase the demand. So you want to take a look at all the amenities and really get a full picture when you're looking at different units available for rent. You can also talk to property managers in the area. So when I bought this property, I talked to 3 different property managers who gave me an opinion of what they thought this unit could rent for, in addition to looking at the actual for rent listings in the area. So after doing my due diligence, I knew that this property that I could buy for $417,000 could rent for at least $3,000 to about $3,300 a month. I was eventually able to get the high end of the rents because when I put it on the market, I leased it to the United States government of all people, and then they were able to put in a military tenant and their family in the house. So I was able to get kind of the higher end of the rent range that I got. So it definitely worked out. But when I was underwriting the deal, this was the number I was using for my rent projection. So if your property has other units, or if it's able to produce additional income from a laundry machine or storage or parking, then you can also add that into your gross revenue. So at the end of the day, you're just trying to understand how much can this actually produce in rent. So let's say we have our $3,300 a month in income. You can't just put that in your pocket and expect not to pay any expenses. So now let's talk about the expenses on a property. So when you're underwriting a deal, it's up to you to really be a detective and peel beneath the surface and ask a lot of questions of the seller, the listing agent, and really understand what the true expenses are going to be on a property. So do your best to guess at this point because you can't really see into the future, but you can look at what the property tax rates are in your area. You can look at your mortgage payment. You can look at a lot of these things to get your best idea of what it's actually going to cost you to own the property. Keep in mind that every property has expenses. It's just a matter of fact of owning rental properties. So the main expenses that every property is going to have is pretty much going to be a mortgage, right? So most people don't just have lots of cash sitting around, so you're gonna use financing to buy a property. So this is usually gonna be your biggest expense. You're gonna have to pay property taxes as well. So every property is going to have property taxes, which are usually paid with the mortgage, but a lot of times if you're paying cash, you're gonna have to pay them twice a year. You're also gonna wanna get insurance, right? You're gonna want property insurance. If you're getting a mortgage, the lender is going to require it anyways, so you wanna factor in insurance costs as well. You're going to have maintenance costs. There's really no avoiding maintenance. Even if you're buying a brand new construction property, there's always going to be things that come up when you have tenants. You're also going to have utilities. These are, the gas, electric, trash, sewer, water. So depending on your setup, you might be able to bill the tenants for all utilities. So that's the one thing I like about single family rentals is that they're on a single meter, so you can always have the tenants pay those utilities without much of a problem. You might also have an HOA. So if you're buying a property like this one, which was in a homeowners association, or if you're buying a condo to rent, then you're going to have these types of fees, which are usually paid monthly or quarterly. You might also have a leasing fee. If you're using a leasing assistant, you might have property management. If you're buying properties out of state, like I am, you're gonna hire a third-party property management company so that they can handle a lot of the day-to-day, the maintenance requests, the tenant management, and the turnovers, because it's very difficult to do if you're a long distance. I am actually self-managing this one, so it was a lot easier with a brand new construction property, so I could save some money on that. And while it's not an actual expense, you definitely want to factor in some vacancy. So just because your property can produce money every month doesn't mean it'll be occupied 100% of the time. So you want to factor in some vacancy, meaning that your property is not going to be rented every single day of the year, because you're going to have tenants that move out. You're going to have some time in between, maybe a few weeks, maybe even a couple months in between tenants, just depending on how well you're priced, depending on your market. So you're going to want to factor in vacancy just to account for the time that your property is not rented. So let's talk about how to actually determine these expenses for your property. So to determine your mortgage, you need to figure out how much money are you actually borrowing. So when you have your purchase price, you need to factor in your down payment. So how much cash can you actually put into this property, and how much of a mortgage can you actually qualify for? So you need to understand your down payment amount and also the interest rate at which you can borrow the money. So this is where you talk to a lender and understand if you're pre-qualified for a loan, and if you are, roughly what's the interest rate that you're expected to pay for the mortgage. You can go to really any mortgage calculator on the internet and plug in your purchase price, your down payment amount, and your interest rate to determine what's your monthly payment for your mortgage. So in my case, I was borrowing about $313,000 at 5.5% interest rate, which at the time was a great rate and was about 2% lower than the market rate because I bought directly from a builder and they had an incentive to move their houses. So they gave me an amazing interest rate, which was 5.5%. My mortgage payment was about $1,777. So I'm just gonna put that right here. So this was my monthly mortgage, right? I'm bringing in over $3,000 a month. My mortgage payment, this is the principal and interest. This doesn't include taxes and insurance. So my property taxes were about $150 per month, okay? What you can do is simply look up the tax rates in your market. Talk to your title company, talk to a real estate agent in your area, look it up online, and then you can simply multiply your property tax rate by the purchase price. Because a lot of times when you're buying a piece of real estate, the property tax amount gets reassessed and it might be higher than what the seller is paying currently. You can look it up on Redfin. There's in Zillow, there's a price history for the tax amount, but that might change after you buy the property. So pro tip, you want to understand what the tax amount's going to be after you buy the property, because you might be surprised if it shoots up and it can eat into your cash flow if you don't account for it. So we have our mortgage, we have our taxes, and now let's talk about insurance. So you can easily get a quote for a particular property from an insurance broker or an insurance agent within a matter of days. So it's better just to go directly to them, and eventually you'll start to have an idea of what number will work for you and what numbers will work for properties in your market. So in my case, this was about $84 per month for the insurance, okay? Now, with your maintenance costs, right? How are you gonna know what your maintenance costs are gonna be in the future, right? In 12 months, 24 months, in 10 years? It's very, very difficult unless you have a crystal ball. So what a lot of investors do is they'll actually allocate a percentage of the rent that you're bringing in to cover the maintenance costs. So for me, I'll allocate a certain percent, anywhere from 5 to 10% of the gross rent to be allocated towards our maintenance budget. Because this is a brand new construction property, I only budgeted about 5% of the gross rent, which was about $164 per month going to my maintenance costs, right? This is for anything that comes up when my tenant calls me and says, hey, the oven's broken. Hey, my refrigerator's leaking. You know, this is the budget that covers those items. I've purchased properties that are over 100 years old, okay? So I would not only budget 5%, I'd probably budget 10 or 20% of my gross rent to cover maintenance costs if my property had a lot of deferred maintenance, or if it was very old and I knew that it was gonna have a lot of reoccurring issues. So I don't stray away from buying older properties. You just have to make sure that you have more than enough cash flow to cover the maintenance items that do come up. So you probably are gonna have some utilities costs, but if you're buying a single family rental, then you might be able to structure your lease to where you don't have any utility costs. So in my case, I was able to pass it all to the tenants, so I didn't have any utility costs. If I did, it might have just been very nominal, so I didn't factor that into my underwriting. I did buy it in an HOA, as I mentioned. This is a homeowners association, and a lot of them do charge a fee. So in my case, it worked out to about $39 per month. This is for things like the security, for the common area pools that the homeowners association offers. So they do provide some amenities, in some of these HOAs, so it's not all bad. So you just want to know for sure. You can easily find this out from the seller, from the listing agent. You can review the homeowners association documents to really get a firm grasp on what those costs are. In addition, I did self-manage this property, and I still do self-manage this property, but I'm not in the property management business as a full-time investor. So I do still factor in management costs, because eventually I will delegate that management to someone else, to another company. So what you can do is look up the property management rates in your area. I found in buying properties all over the country, it's usually around 8% to 10% of the gross rent collected per month. So in this case, it was 8% that I budgeted, or $264 per month. And that also included the leasing fee as well. So again, different management companies have different pricing structures. So once you do a little bit of interviewing of property managers in your area, then you can determine if you want to add an additional leasing fee. So I'll usually budget 8% for management and call it a day for my initial underwriting. And last but not least, we have our vacancy. So like I mentioned, a property is not going to be occupied all the time. So you're going to need to factor in some of the days of the year, some weeks, maybe even some months of the year where it's not occupied and not producing rent. So we simply take our gross income and multiply it by about 8%. That's about 1 month of the year completely vacant, which I think is pretty realistic when you factor in turnovers and the time it takes to find a new tenant and for them to finally move in. In some markets, I will tighten this up to maybe around 4%, and in others, it might even go up to 10%. So this just comes with knowing your market. But in this case, it's about 8% or another $264. So this covers all of the expenses that I'm realistically looking at when buying this rental property. So let's just add this all up and see what that amounts to. We've got our mortgage plus our taxes plus our insurance plus our projected maintenance costs. Didn't have any utilities, our HOA, our management fees, plus our vacancy budget. So that gets us to $2,742 of total expenses. At this point, we know that we can produce some cash flow just from a quick look. Now let's determine what's the actual cash flow over here, okay? So we've got the monthly rent minus our total expenses equals our cash flow. So now we've got, this is our cash flow number, 558. Cash flow per month. So from here, we want to figure out how much does that translate per year, okay? So we simply multiply that by 12 to get to our annual cash flow number, $6,696. This is called our annual cash flow. This is the passive income, right? Because we have our gross revenue, we have our monthly expenses, and then after a full year, this is it. So it's not just that number that we want to see. We want to get to our cash on cash return. So if you recall, the purchase price is $417,000. So I put 25% down on this property, and that was ultimately about $104,000. And with some closing costs, I think roughly $6,000. So let's just round it up to $110,000 was my total investment in this property that was producing this amount of money year one. So we have our annual cash flow divided by the total investment, a little over a 6% cash on cash return, okay? %, is that great or what? You know, it's really about compared to what. So I know that 6% is a pure cash flow number because I did factor in a lot of the expenses that may or may not come up, right? We have our vacancy, which I've had this property leased for 2 years straight without any vacancy. I'm also self-managing. So if you take these out of the equation, even just the management piece, this is closer to 8%, maybe even closer to 9%. So you want to be conservative with your numbers because the last thing you want to do is to buy a deal where you haven't factored in all of these expenses and you're barely breaking even, or worst case, you'd be negatively cash flowing. So you never want to be buying a negative cash flow kind of deal because that means you're having to pour into that property every single month. And that's the last position that you want to be in. So to be honest, I don't get very excited about a 6% return on anything, especially when you're shelling out over 6 figures to buy a property. So why would I buy this deal, right? So again, like I said, it's probably closer to a 8 or 9% cash on cash return because I decided to self-manage this property. I'm using some software, I'm using some efficiencies, I'm leveraging my boots on the ground so that I don't have to pay an 8% management fee. And I've also signed a 2-year lease to make this vacancy number pretty much vanish. So the cash on cash return is probably closer to 10% in reality. But even if I did have a third-party property management company, this return is acceptable to me, and you have to ask yourself if that's acceptable to you. What we're not covering right now is the other layers of return on investment that a rental property produces. What's not listed here are the tax benefits, okay? So when I buy a property that's over $400,000, I'm also able to do a cost segregation study on the property, which breaks down the structure value, the building value, and actually allows me to take a much larger deduction against the income I'm producing in my business because I'm taking large amounts of depreciation on this property. That's something that real estate investors get access to, are amazing tax benefits from doing a cost segregation study and bonus depreciation on their properties. So from doing that, I was able to earn an additional $18,000 of tax savings in that first year of ownership. This is essentially money that I didn't have to pay in taxes because I depreciated the property significantly. So this is one of the amazing things about buying real estate is that you can create paper losses which can offset your income in certain situations. So the less taxable income you have, the less taxes you're gonna have to pay at the end of the year. But there's also the impact of paying down that mortgage. So every single month, part of this payment is interest and part of it is principal. So about $350 a month of this payment on average is paying down the loan balance. So I borrowed over $300,000, but over that first year, there was an additional $4,200 that I paid down on that mortgage. And when I say I paid it down, it was actually the tenant who was paying me, and then I used that money to pay my mortgage. So at the end of the first year, I paid over $4,000 off of that loan, which is ultimately growing my net worth by just owning this rental property and paying off that mortgage. So when you add them all up, let's see what it actually turns into, right? So $18,000 of the tax savings plus $4,200 of the loan amortization plus the cash flow, that gives me a total return down here of $28,896 in the first year. So this is what a lot of people don't really realize when it comes to buying and holding rental real estate is that there's many layers of the return on investment that you're actually achieving. Why do I focus on the cash on cash return? Because this is liquid money that you can actually put into your bank account every single month and really do whatever you want with. But when you get this down right and you have a property that does produce an acceptable yield on your money, then you know this stuff is happening at the same time, which can amplify your returns like nothing else can. And this doesn't even factor in that I'm buying this property in one of the highest growth markets in the country, in Nashville, Tennessee, that is projected to continue to appreciate in value. So this number doesn't even factor in the appreciation that the property has achieved, which might be 3% to 5% per year, but I'm not banking on that appreciation. And if I factor that in, this return would be a lot higher. So if I took this and factor that into the total investment of $110,000, I'd be looking at a 26% ROI. That, my friends, is how you can get double-digit returns with one rental property. And keep in mind, this was a property that I found on the MLS. I didn't spend $1 in marketing, and I paid full price for this property, bought it with a mortgage, and haven't even seen the property and am managing it myself, but eventually I can hire the property manager and factor that into these numbers. So you tell me where you can make a 26% return in the first year on a safe investment like a single family house. And keep in mind that this is a brand new construction property that I essentially paid full retail value on the MLS, buying with a real estate agent without having to negotiate a lot or spend a lot of marketing. I'm not sending mailers and cold calling all these sellers to convince them to sell me their houses. I'm just doing boring old buy and hold real estate and long-term rentals and seeing these kinds of returns. So I just want to encourage everyone to see beneath the surface, to run the numbers, and by analyzing rental properties like a pro, actually doing the work, you're going to realize that there's a lot of opportunity out there that otherwise you might have been missing out on. So I'd be more than happy to just continue pouring any investment capital that I can into deals just like this, where I'm earning double-digit returns on what I consider one of the safest and most secure investments that can help me build my retirement and create passive income that's going to outlive me and allow me to continue growing and pass this down to my family. So if you guys liked what you see today and you want to get started buying rentals that can produce double-digit returns, and if you're tired of sitting on the sidelines and want to join a community of go-getters, of investors all around the country who are taking action every single day to acquire assets, to build their net worth, to create a better life for themselves through real estate, check out our free training that is linked below in the description of the video so you can learn how we here at Real Estate Skills help people just like you get started in real estate investing so that you can take action and begin to live the life of your dreams. If you guys have any questions about how to analyze a rental property, go ahead and leave your questions in the comments below. Be sure to like this video and subscribe to our channel for more real estate investing content. I'm Ryan Zomorodi with Real Estate Skills, and happy investing.